you've now got the obligation to buy it from me at a specific price. Now, why is this guy, feel like he's all stressed out? Because he's got time working against him, right? He bought these options, and whatever that time period is, if the market doesn't go up or he's not able to sell them, he's out. He lost his money, right? He's part of that 85%. The option buyer, on the other hand, the option writer, excuse me, he's got the obligation to buy and the obligation to sell. But he doesn't have the pressure of time working against him. Time is working in his favor, just like the house of luck. Any questions on that?
You said the writer is like the homeowner.
The writer is like the homeowner. Right.
Let's go back one step. Keep in mind what's happening here, right? Just clarify the motivation of the various participants. The homeowner, right? Let's say that's you, and they bought that home for $100,000, and they basically are saying, hey, give me $10,000 for this option. I'll sell you the option for $10,000, and I'm willing to take 10% profit for my house and be done with it, right? So that's the motivation of the homeowner or the owner in that scenario. This guy, the option buyer, right? He has to be right on several fronts. One, first of all, he gave up $10,000 for the right to buy that house at $100,000. So one, the house has to be worth more than $100,000 in 30 days. So if the market is going up, right, say that house was $90,000 or appraised for $95,000, he's hoping that the price of the house continues to appreciate, gets to $100,000 within 30 days. So that then he can take his $10,000 option, buy the house from the homeowner for $100,000, and then he's expecting that the market continues to go up so that he can sell that house to that market down there for $130,000. Right? So that's the speculation aspect of it.
Yes, well, this was good. So to just point out is that you can buy and sell options. So you got to determine which side you're on, because there's a buyer and there's a seller, and the contract price, the $100,000 is called the strike price. So we know the instrument. While this is pretty much in words what we just talked about. We've got two people involved in options contract, the buyer and the seller. Go to the next one. So whenever you are thinking about buying and selling options, here are the things you really need to know. Is that the number of contracts that you want to buy or sell. And what do I mean by contracts? Is that one options contract is equal to 100 shares of stock. Okay? Two option contracts are equal to 200 shares of stock. And then 10 is equal to 1,000 shares of stock. That's how much you control. So for that period of time, you're controlling either 100, 200, or 1,000 shares of stock. And that's why one of the reasons that people buy options is that, for this period of time, I can control a lot of stock. So if the stock goes up, $30 or $40, rather than just having 100 shares, I could buy a call option, and now I can control 1,000 shares for that period of time. It's just that time is working against you. Okay? Now you also have to select the underlying security. Now not all options, not all stock options, you really have to, is there something specific to look at today there?
Let's see.
You just have to look, I guess.
Berkshire doesn't have options.
See, typically most companies whose stocks are below $5, they tend not to have options. Most large companies that are say, $2 billion and up tend to have option contracts. When you go to, if you use Yahoo Finance, you put your symbol in and you click on options, it'll let you know if the company has options for it. There's also a Chicago Board of Options Exchange. If you put the symbol in, it will show you guys that. Put the symbol in, options will come up for that particular stock. Okay, but that's one thing that I would suggest in terms of any stocks that you buy. I know you guys being young, and sometimes you guys like to speculate on some of the penny stocks and things of that sort. You try and select companies that have options so that you have some flexibility to, in the future.
Okay, and now, one other point is that options, you can trade them at any time that the market's open. Even though, you may have bought a weekly or monthly or 2-year option, you can trade them at any time, if the premium is in your favor. Now, and that brings us to the next point, is that the expiration date on options, they now have weekly options, you have monthly options, and you get options for a year or even 2 years. And that's the time period. And that's the time period on which, you're in agreement or in contract with the seller that, hey, I want to control your stock for either a week, a month, or 2 years. And that's the expiration date. Now, the strike price is the contract price, right? That's the price that I agreed to buy the house at. Or the price that I agreed to buy or sell the stock at. That's your strike price.
One additional note for your expiration date: options expire the 3rd Friday of every month. You go to the calendar and you look at whatever date the 3rd Friday is for that particular month, right? If you have an option contract for that month, they expire on a monthly basis.
Okay. Now the option price. Let's talk about that. Now, when you go to an options chain, and I'm going to show you that in a minute, you're going to see a bid price. This is what somebody is offering to buy it at, and an ask price. Someone is willing to sell that option. Okay. Now, let's take this little example. Is that if you happen to say on any stock, XYZ stock, if you were going to pay 45 cents for the option, okay, and you have 2 contracts, which is 200 shares, okay, it's going to cost you $90. So this is $90 to buy it, and you're going to give $90 to the seller. Okay, so if you're on the sell side, you're going to receive $90. If you're on the buy side, you're going to pay $90. That's a little confusing. Well, but now it's important because you're a smart.
Facial expression. I'm
No,
gonna
ask
give
No, go
the
ahead.
person I'm buying it from, and I'm also gonna purchase it for the 90.
Right. If you're the buyer,
Yeah.
then you're going to give $90 in. Okay. If you're the seller, and he's the seller in this case, right? He's now giving you the right to buy that option. Okay. So
When I
he's
buy
giving
that
you the
option-
right, and he's taking on the obligation.
Okay.
I mean, that's, but after, if it's not clear, we can.
It sounded like